Welcome back. You're watching the last edition of Business Morning for the month of November on Channels Television. And today on the program, we're still continuing our discussion and focus on the Monetary Policy Committee's pronouncements, which were made on Tuesday. Today on the program, our focus is on how those pronouncements will affect investment in the country. I'm being joined on the program by a professor and head of the Economics Department of the University of Lagos, Ndobisi Wokoma, and the Chief Executive Officer of Kari Assets Management Limited, Mr. Johnson Chukwu, also joins me on the program to be part of the conversation. Good morning, gentlemen, and thank you so much for coming in.
Thank you.
Well, it's been an interesting week, wouldn't you say, because a lot of analysts had actually expected that the Central Bank of Nigeria, the Monetary Policy Committee, will maintain status quo, but then we saw a further tightening in the monetary policy rate and the increase in cash reserve requirement on private sector deposits, and of course the depreciation in the naira, moving the band from 155 to 152. So today, let's talk about the implication of those actions on investments. How much do you think it would actually affect investment in Nigeria? Mr. Chukwu, let me start with you.
Well, I think the measures will deter investment in local economy, particularly from local entrepreneurs. And basically what's happening is that the banking system liquidity has been adversely affected. So the implication is the banks have very limited resources to lend. The banks are now struggling to remain liquid. If you see what has happened, I'm not talking of the change, the movement in the exchange rate. Okay, the midpoint from 155 to 168. And I'm talking of the increase in cash reserve ratio on private sector deposits from 15% to 20%, which is a 500 basis point increase. The implication of that is that, and that was immediately debited on Wednesday. So a lot of banks, when it was debited, you saw that the OBB, that's open buyback rate, moved to 30%. And that means a lot of banks went into a state of temporary liquidity. And they need to shut down credit, because what banks will do is that in a crisis situation like that, they will sacrifice profitability for liquidity. And when the banking system begins to shut in on liquidity, the implication are that entrepreneurs and business will no longer be able to access funds for investment purposes. So you're going to see a slowdown in investment. And that's the challenge we have in the policies. In as much as it was inevitable for the country to devalue the currency in the face of slowing down in foreign exchange earnings and increase in demand, it was inevitable. There was nothing we could have done to devalue. But I do not think the devaluation should have been accompanied by a 500 basis point increase in private sector deposits. What the government said, what the central bank said, they want to reduce the demand for FX. They want to stop the banks or reduce the banks' ability to create credits, to create money, to lend. And by doing that, they have effectively slowed down economic activities. They're going to effectively slow down economic activities. And let me tell you one area that we must recognize. The primary objective of devaluation is to discourage importation and encourage exportation. Is to make foreign goods more expensive to your citizens to consume and make your goods cheaper for foreigners to buy. And for that to happen, you should have the local base to support that import substitution. So when you devalue, you should also encourage or stimulate local production. And that should come in form of access to capital and the cost of capital. We already have a lot of inclement challenges in the economic environment, issue of infrastructure. But we should not overburden entrepreneurs by further increasing their cost of borrowing. And I'll give you a classical example. If you take, for instance, a bank that has an average weighted cost of funds of 10%, and they now have to have 20% of their deposit sterilized. For that, on that 10% cost, the effective cost to them, if you have sterilized 10% of their deposit with central bank, is that the cost would move to 12.5%. So they are going to have because they have to recover the cost of the 100% deposit on 80% lending.
Professor Wokocha, it seems as if, sorry, I beg your pardon, Professor Wokoma, it seems as if the situation, as Mr. Chukwu has actually, pointed out, is very tight. It's interesting and tight at the same time. But then again, there's a very huge gap that domestic investors can actually fill. But do they have the power to fill that gap?
Before we discuss that, I think I want to say that for every policy action you take as a government, there are always side effects. Like you take a medicine, I was discussing with my colleague. For policy choices, you always have trade-offs. And then when you look at the trade-off from the lending side, like he has looked at it, you can say that you have a high cost of funds. Therefore, people cannot access funds as they will need. But if you look at it from the other side, for those who are who have funds to deposit in the system, there will be an incentive for them to offload all the excess cash they may have, if there are people like that in the system, the support of the economy. And then, you have some more money entering the system because you have an increase in deposit rates, and that will more or less tend to cushion the other side effects, which banks don't have liquidity because of the tightening, by the Central Bank of Nigeria. So I think the effects are not necessarily one way. And, just like in any economic policy action, you always have choices. You have the scenarios. You have this scenario has its side effect and has its setback, has its trade-off. For example, the economy, you can never at the same time solve unemployment and inflation at the same time. There must be a trade-off for any action. And what government has done now is to react to what has happened externally. They've reacted, and the issue is now cut back. There are side effects, there are trade-offs, and I think the investment climate will also be affected, in terms of the changing of the rates. Cost of funds are now quite high, and the markets will also react to it, and it will affect investment negatively on one side. And so I think the issue is for us to take time for most actions to actually come into effect and to see actually how they play out, because sometimes you have a policy action. It takes some time for it to simmer through the system, and then you can now see, apart from what you postulate that it may be, because you have the theory, then it has time to simmer through, and you can now see that this thing will actually have this. So I think, in my opinion, what has happened is in order, in my opinion. But we need to now look at the situation and see how there must be trade-offs, and some areas will have to suffer in the economy for us to move forward. China, at a time when they closed their economy, there were problems. They closed their borders, and they had problems with consumption, with production, but they had a program to be able to compete, to be able to provide for what they were importing. And it took a long time for them to come out of it, and now China is a very strong economic force.
Which is the reason why I asked you the question.
Yes.
Do we have, domestically, domestic investors have what it takes to close that gap? That gap that has not opened.
The problems are basically macroeconomic. There are many factors, infrastructural, the environment, issues of security, provision of power, and all that. Like when we had our GDP rebased, we found that the gap was very wide in the middle. The economy was agrarian. We now moved to services largely, and then we had a very large GDP value. The middle manufacturing was actually very, very slim. So that capacity is not there because of the environment. It's basically macroeconomic. And unless government will address those fundamental issues, if not, this gap will always be there. So that capacity is actually hampered. And so government should do more. At that point, I agree with you. Should do more to fill that gap, to provide what it takes for entrepreneurs to be able to produce, and fill the gap that will be created by virtue of closing, making things more costly for people to consume locally.